and thanks for joining us today for another edition of the Wealth Guardians radio show. I'm your host, I'm Doug Ray, and I really appreciate you spending some of your weekend with us. And, of course, JB, he's right here with me in the studio, as always. I think he camps out and lives here. How you doing this morning, JB?
You figured me out. I never leave. I've got a little room in the back. No, glad to be here with you, Doug.
Yeah. So, we've had kind of a crazy couple weeks here in the market.
Oh, my goodness. I mean, a lot of volatility last week, and everybody's talking about it, and maybe we can talk about that here,
Yeah, we will. I'm going to get into the market a little bit this morning. It's been a while since I've done any market talk, and I think this is probably a prime time to do it.
Right.
But first, as always, I want to salute our men and women in the armed forces and all of our first responders and along with their families for the sacrifice and the service to this country and the community. Thank you so much. We really appreciate you. And any first-time listeners out there, I'm Doug Ray. I'm the founding principal of Ray Financial Group and the Wealth Guardians radio show. We are an independent financial firm working with pre-retirees and retirees in all areas of retirement and estate planning. We are fiduciaries, and I have always served my clients that way. We have offices in the Triad as well as Charlotte. I've got a very unique approach that I believe I can best serve my clients by positioning them to avoid losses versus picking the winners. And for the last 20 years, I've successfully helped hundreds of my clients protect what they've saved for retirement against loss and still enjoy the benefit of market gains to ensure retirement income will last a lifetime. The goal of this show is to educate and inform listeners of up-to-date, relevant, and important information in the pre-retirement, retirement, and estate planning arena. And JB and I look forward to spending the next 30 minutes with you and giving you some solid financial information that hopefully will help you make a difference. Now, before I get into the market, JB, I want to plug my next workshop.
Sure.
We're doing this on February the 27th and March the 1st. It's going to be 6:30 p.m. In Clemens at the Broyhill. And this one is a little bit different. It's titled Don't Worry, Retire Happy. And we're going to be talking about a lot of different things. We're going to talk about the math and science of an optimal retirement. Again, we'll talk about Social Security as we always do because that is a key component of your retirement. And we're going to talk about longevity and how that multiplies the risk over a lifetime. So that's Tuesday, February 27th, March the 1st. All at 6:30 p.m. in Clemens at the Broyhill. So give us a call if you want to come. You have to register. It's 336-391-3409, or you can also go on my website and register there at www.thewealthguardians.com.
And I'm sure if you are thinking about this, you need to go to one of these seminars. Doug can really help you out. Well, Doug, of course, we mentioned it earlier when we opened the show. It was kind of a wild week this past week, and you had a lot of folks saying this was a correction. You had some of the Chicken Littles out there saying the sky is falling, but you're the person who can maybe sort this thing out. What in the world happened this past week?
Well, I think it was magnified because we haven't had a 5% correction in almost 2 years. People just really got lulled into complacency, and then boom,
right,
it all blew up in our faces.
Sure did.
So, we had Monday, I think, the single highest point drop in Dow Jones history. We have virtually given up all of January's gains. We more than had a 5% correction. And it all got started February the 1st when the Atlanta Fed came out and said, I think the first quarter GDP is going to be over 5%. Well, JB, we haven't had a 5% quarter in, I don't even remember.
Right.
I mean, it was probably in the Bush administration. It certainly was not in the Obama administration. But what that did was this. It got market players thinking that, if we got a 5% quarter coming up and maybe there's another one behind that, and with all this money that corporations are bringing back into the economy, we might have inflation.
Right.
And so that caused concerns, and we have seen interest rates ticking up now for about 6 months or more. So there's some selling, some profit taking took hold. And then, all of a sudden, the computers kicked in. Mm-hmm. Now, this is a pet peeve of mine. All these bloody computers that Wall Street firms are using to trade thousands and millions of shares in nanoseconds for a penny here and a penny there. What they do is their algorithms start to interact with one another, and one computer looks at another computer and says, "Oh, you're selling? Well, I better sell." Right. So now we got a domino effect going on here. Mm-hmm. And that's exactly what took place. And the reason I don't like this computer program trading is because there's not a human element behind it.
Yeah, that's kind of scary.
Yeah, there's nobody saying, okay, I'm going to sell ABC stock because of all these different reasons, fundamental or whatever they are. You just got a computer executing trades on algorithms, and they buy long and they short and everything else. Let me give you an example. I was on the radio with KC this week, and I told him this too. I first got into this business in October of '88. It's almost 30 years now. And back then, the average volume, the average number of shares traded on the New York Stock Exchange was 150 million. That was a good day back then.
150. Okay.
You have any idea what it is today?
It's probably something that starts with the B word, I'm assuming.
It is. It's between 2 and 6 billion shares a day.
Wow.
And when you have volatility like we have had this past week or two, it's closer to that 6 billion number.
That's incredible.
And again, they're doing it for a penny here and a penny there. And if you're trading 6 billion shares for a penny or two, that eventually adds up to real money.
Absolutely.
And for that reason, I'm afraid we'll never see the end of it,
Right.
because it's just way too much money for the Wall Street firms to pass up. Unfortunately, what it does do is it does affect our retirees. They look at these crazy ups and downs. They look at their account statements, and sometimes some of them get panicked and they get out of the market. Sometimes they don't. But the volatility is nonetheless, it's there. Now, some people have said this is the beginning of the big one.
Right.
I don't think so. I've said many, many times there is one big, nasty bear market out there somewhere in the future, but I don't think this is it.
Okay.
It may be a year or two down the road, but not now. There's just too many strong fundamental reasons why this market, I think, continues to go higher once we digest this little bit of indigestion we've gone through. I could name them off, and we've talked about them before, but the tax reform, the repatriation of these billions and billions of dollars of corporate cash sitting over in foreign lands. Mm-hmm. We've already seen what companies are doing. They're giving raises. They're paying bonuses. Apple announced they're going to bring back $350 billion.
Right.
And they're going to put it to work. They're going to buy some stock. They're also going to put it to work in R&D and plant and equipment and their people. That's what's going to happen.
Right.
And for that reason alone, I'm pretty bullish. But when we have times like this, it does unsettle people. They get a little bit scared. And, if you're one of those, if you're nervous, if this caught your attention this week and you want to talk about it, give me a call. Number's 336-391-3409.
Sounds good. Well, earlier we kind of wanted to talk about the market, but we also want to talk about something that's very important. It's a new world when it comes to retirement planning, Doug. And we've got a very important show for you. And we've got some principles that we'd like to lay out. The first new retirement principle is to diffuse the ticking time bomb in your IRA and other pre-taxed retirement accounts.
Yeah, JB, you're right about that. IRAs are probably the most valuable asset that most people own going into retirement, and most people save in their 401ks and their 403bs and their defined contribution plans. And that's how they build up that big retirement nest egg and their asset. So with the demise of the employer guaranteed pension plan, the key to financial security these days is making those IRAs and 401ks as large as possible when you retire and making them last your whole life. Mm-hmm. However, the main problem here is your IRA and your 401k, your 403b isn't as valuable as you might think. And that's because you don't own all of it. Unfortunately, you got a partner in this little business, and his name on that account with you is Uncle Sam.
That's right.
So you got to remember, you took a tax break when you contributed to these plans over those years. The gains were growing. They compounded tax deferred. And the problem is that it's not tax free. It is tax deferred. You don't get out of paying taxes on those dollars when you withdraw money in retirement or whenever you decide to withdraw it. You just have to spend it. And it's going to get taxed, and it's going to be taxed as ordinary income at whatever tax bracket you are in at that time and whatever tax rates are at that time. So the real value of a 401k or a 403b isn't the amount you see on that statement or on your computer screen. You just can't look at it that way.
Right.
The real value is the account's market value minus the taxes that are going to be due on those distributions. You spend only the after-tax value while the IRS gets the rest of it. So the key is what type of money is twofold. One, not to save too much in tax-deferred plans where it will cause you major taxation in retirement, or two, to figure out how to get that money out of these accounts with the least amount of taxes. Now, I see we're going up against the clock here. We got to take a break here in just a second or two. And we're going to come back to this when we come back from the break, JB, because this is such an important principle.
All right. Well, stay with us. You are listening to the Wealth Guardians radio show, heard locally here on 94.5 WPTI. We certainly appreciate you being with us. Once again, if you'd like to contact Doug, 336-391-3409, or at our website at www.thewealthguardians.com. Stay tuned as we have several more retirement principles to get to that you must follow to help you have a successful retirement in today's world. Stay with us. We'll be right back.
I fell in love with you, and if all my dreams come true, I'll be spending time with you.
Welcome back to the Wealth Guardians radio show, where we tell you what you need to hear, not necessarily what you want to hear. We're right in the middle of our updated retirement rules and principles show, where we have been sharing with you the main things you have to do now that are different from the past in order to have a successful retirement. And Doug, before we went into the break, you were talking about taxation on your retirement accounts. Can you tell us more there?
Yeah, absolutely. I mean, folks just need to be aware that taxes are owed when you take monies out of these plans. And when it does come to taking the money out of the accounts, you want to make sure you got the proper information, education, and know strategies you can get that money out with the least amount of taxes and other consequences. And one way to start, folks, is we're going to be talking a lot about taxation in the upcoming workshop that I have called Don't Worry, Retire Happy. It's going to be Tuesday, February 27th, and then on Thursday, March the 1st, 6:30 p.m. at the Broyhill out in Clemens. So come on and learn about how to manage these taxes. You got to register. It's 336-391-3409, or you can do it online at our website. That's www.thewealthguardians.com. You know, a very big retirement rule, because most people just simply forget about the money in their pre-tax retirement accounts, is they forget what type it is, and they don't think of taxation issues they're going to face down the road. Now, I know we just got a new tax bill, and it's a tax cut for most people. That's a great thing. But what I'm looking at here, it's a temporary short-term period where you can do some really good tax planning and make some tax savings moves, because I really believe in the mid-2020s, when this bill expires, tax rates are going to skyrocket.
Oh, you know it.
I mean, it just mathematically makes sense. You have to look at this massive debt issue that we have to deal with. The interest rates are going to start rising, and they aren't going to have any other choices but to raise taxes to start paying for all this. So let's take advantage of this new tax code for the next 2, 3, 4 years, however long we've got it, and start making some tax efficient planning down the road. It all comes down to proper education and a strategy to work with a retirement professional. Work with that retirement professional now. Make sure you're doing the right thing for yourself and your family. That way you can make sure you make smart tax moves now and do the right thing and adapt to this new principle.
Well, Doug, the new next updated retirement principle kind of goes along with that one, and that is to understand how the tax code works and to avoid as many taxes as possible in retirement.
Yeah, that's a new principle as well because, again, like we just said, people don't pay much attention to taxes in retirement.
Right.
And unfortunately, there's a ton of them. Mm-hmm. You know, we've been led to believe that when we retire, we're not going to be making as much money and therefore our taxes are going to go down. Mm-hmm. That's just not necessarily the case. You just can't forget taxes in retirement the way the tax code is set up. Unfortunately, taxes on some types of withdrawals like the IRAs and the 401ks will go well into what's called provisional income. And we've talked about this before on this radio show. But that causes other assets to be taxed. If your provisional income is over certain levels, then that draws in your Social Security income to be taxed at certain limits. There's a strategy involved here, and if you properly understand how the tax code works, then you can actually save the proper way and distribute the proper way in order to minimize or even eliminate taxes on that Social Security income. If you don't know how this tax code works or how everything is treated, then there is no way you're going to know how to properly draw and minimize those taxes. Again, that's where professionals come in to help you. Many people don't give a lot of thought to income and tax planning in retirement, and it's key. It's absolutely key. If you know what you're doing, you can legally draw things the most proper way from each bucket of retirement monies at different times in order to minimize the tax consequences and maximize your income and your assets. It's very key to understand this. Again, the new retirement principle is to make sure you understand how the tax code works. Stay up to date on tax laws. And by doing that, you will have the opportunity to avoid as many taxes as possible in retirement.
This is good information, Doug. Well, the next retirement principle is to get your investment strategy updated to modern times.
Very important here, JB. Again, we've talked about this on a few shows in the past. Mm-hmm. Investing today is a lot different than it used to be.
Sure
and we talked about the first opening part of the show. Volatility is now up there again. The market, it's a lot more volatile because there's so many more options, so many more tools. The markets are open 24 hours a day now. Back when I got started, they weren't. In the past, most people just simply used a very simple, traditional asset allocation-based retirement philosophy or strategy. Mm-hmm. Basically, you just buy a set percentage of equities and bonds and maybe a little bit of cash and just let it ride. Mm-hmm. You just hold that percentage and ride the market up and ride the market down. The idea then was to diversify, so you try to avoid a lot of the big risks, but just hold on your investments with the thinking that the market will always be higher in the future. JB, even if that principle's true, which I'm not sure about that anymore, when you get into your pre-retirement and retirement years, you don't have the time necessary to ride those waves up and down. Mm-hmm. So as you get into retirement, you have to start drawing that money out now. That's different for pre-retirement when you were putting money in. This is your nest egg. You got to live off of it. And you can't go through down periods and draw money out because that is a recipe for absolute financial disaster. Mm-hmm. You got to have a plan in place, an updated investment philosophy in place that will adjust your holdings and adjust what you invest into different changing market environments. So when market environments are low risk, like I think they are now, when we're in this big raging bull market, then your investment portfolio, your investment holdings should be mostly allocated to equities to take advantage because that risk is really low right now. A lot of equities right now are less risky than bonds. It makes more sense to own more equities right now to take advantage of that but then market conditions will start to change and the volatility picks up again. You know, I said before, there's a big nasty bear market out there somewhere. Mm-hmm. You know, one way we take advantage of equities in this bull market is we use a lot of indexed annuities in our planning. And I think right now in the environment we're in, that is a perfect replacement for a bond allocation. You know, interest rates are going up. And as interest rates go up, the price of the bond goes down. They have that inverse relationship. So let's replace the bond allocation with an indexed annuity, because if equities continue to go up, like I think they will for the next couple of years, you're going to get those growths in those indexed annuities. We've had some incredible returns in some of the programs we've been using. Last 2 years, some of our programs have averaged over 20% a year. That's in a perfectly safe and guaranteed investment tool. Mm-hmm. It's not even just a replacement for a bond strategy. It could also replace an equity strategy, especially if you're a very risk averse investor. All right, so if that caught your interest, if you'd like to see what I'm talking about with some of these indexed annuity portfolios and the returns that we've had over the years, give us a call at 336-391-3409. Be glad to show you what I'm talking about and how I use them in a blended portfolio. JB, what's next, man?
Well, the next updated retirement principle let's talk about is to include estate planning in your retirement planning.
Yeah, absolutely. You know, in the past, estate planning was thought to be just for ultra wealthy folks.
Right.
Those, they do the estate planning to reduce or eliminate estate taxes. Now, this is just not the case anymore. Estate taxes are basically being eliminated. In order for estate taxes to come into play today, you have to have a ton of money, and most people don't have that much money.
Right.
It's $10 million or more. I think if we're a couple now, it's over $11 million.
Wow.
to update you. But estate planning today is about seeing that your hard-earned wealth goes to those you want it to go to, the most effective way and efficient way possible. Estate planning involves reducing family conflicts, and let me tell you, that's a big one.
Oh, yeah.
I've been in the business now 30 years, and I'm telling you, every time I see a situation where an estate turns over, there's typically there's something going on there that's a conflict. Mm-hmm. And again, this is something we want to try to eliminate as much as possible. We also want to try to reduce the transfer expenses, reduce the delays of reducing the probate costs, and avoid mismanagement, and obviously avoid creditor claims and a lot of other things. Unfortunately, when money's passed on, a lot of things come into play, such as taxes, state issues, probate fees, and attorneys.
Yep.
A lot of things come into play, and we have to try to plan for those and to eliminate as much as we can. Fact is, most people today have some legacy desires, but unfortunately, a lot of people just haven't done any estate planning. They just don't think they need it, and that's just not the case.
Right.
You do need it. There are a lot of valuable things that you can do in your estate plan, even if you're not wealthy. All right, one more time, folks, before we shut the show down for today. Again, thank you for joining us. Our next workshop is going to be Tuesday, February the 27th, or Thursday, March the 1st at 6:30 p.m. out in Clemens at the Broyhill Office and Convention Center. No cost, but you do have to reserve a seat. We had a really big turnout for our Social Security workshops last month, so you don't want to miss this one. The number is 336-391-3409, or register online at thewealthguardians.com. We're going to be talking about Social Security. We're going to be talking about taxes and estate planning and how to avoid taxation. And we're going to talk about why longevity now is a risk multiplier. So, as we close, I'd like to ask you this. If what you thought to be true about money was not, how soon would you want to know? Over the years, I've seen time and time again that most folks will be fine in retirement without hitting that proverbial home run. All they have to do is to protect themselves against market losses. Protecting your retirement against market loss is my unique approach, and I've helped hundreds of families in the Triad create lifetime income and truly enjoy their retirement. I hope you have a terrific week. Don't get too worried about this market, and we'll be back next week.